Hello and welcome to Portfolio Matters, weekly markets checklist, week 192. And it's good to be back. We've taken the best part of a month's break due to our holidays, but we'll be back for a bit. But before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, I'm afraid we've got a lot to catch up on. Now, how much we get through it, I don't know. But I prepared a lot of special sections. There's a lot going on. We'll get as far as we can in the time allotted. So, first of all, the news. So, Trump has nominated MAGA supporter Dr. Stephen Mirren to fill a temporary vacancy on the Fed's Board of Governors. That is a 4-month tenure which has to be approved by the Senate. But the Fed is likely to take a dovish turn if he is appointed. Jerome Powell's tenure as chairman of the Fed ends in May 2027, and Trump has released a short list of 2 possible successors, both of whom are likely also to be dovish. So Trump is attempting to fix the board of the Fed with more dovish members who will vote for lower interest rates. He has called for US rates to head towards zero and also called Jerome Powell a moron for not cutting rates immediately. So new worldwide US tariffs came into effect on the 7th of August. The lowlights were Switzerland 39%, which was very unexpected, particularly for the Swiss, Canada 35%, India 50%. OPEC Plus agreed to increase production in September by a further 547,000 barrels a day. Quotas have increased by an enormous 2.2 million barrels a day since March. So previously, OPEC was saying that it was going to take them a year to increase production by 2.2 million barrels. It's taken them 6 months. The danger is that they flood the oil market towards the end of the year. Now, there's been a hell of a lot going on in tariffs. So running through this quite quickly, it seems to literally change every day. So this morning, the US and China agreed to extend their tariff truce by another 90 days to mid-November. US tariffs will remain at 30% on Chinese goods. Chinese tariffs will remain 10% on US goods for now. The US has signed trade deals with Japan, 15% EU, 15% Vietnam, and Indonesia. However, all of these are outline deals, and Japan has since complained about stacked tariffs, i.e., there's 15% base and then 20% on particular goods coming up to 35%, for example, when they thought they'd got blanket 15%. Also, the general approach appears to be that Trump will ask a country to remove particular restrictions on some types of goods. For example, let's say UK food standards. So we ban like chlorinated chicken. And if the country fails to remove those restrictions, he will ask for investments in the US to compensate. That appears to be the way the Japanese deal in particular works. But where there's been disagreement is he has then said that Japan will invest X in the US, but the US will get, quote, 90% of the benefit of those investments, whereas the originating country, Japan, is expecting to get 100% of the return on those investments, as they are the investor. The full detail of these agreements has not been reached. These are outline deals as yet. So, as part of the 39% tariffs on Switzerland, the Trump administration also included gold bars, which sent gold price in the US soaring. Now, He has later said that he will clarify misinformation about tariffs on gold, and the gold price in the US has come back down, but we are waiting that announcement. Copper prices in the US collapsed by 20%. We will take you through the data in due course after Trump announced that tariffs would exclude ore and refined metal. They would only apply to finished and semi-finished products. He announced an extra 25% tariffs on India as punishment for buying Russian oil, taking tariffs on India to 50%. He also announced 100% tariffs on semiconductors not manufactured in the US, with a carve out for Apple, and that Nvidia and AMD would pay an export tax of 15% on their chip exports to China in exchange for licenses allowing those exports. Trump has also promised a small rise in tariffs on pharmaceutical imports this year, but in the coming years, he's saying they will rise to 150 to 250%. So lots going on. Economic news, well, the ECB held rates at 2.15% and saying that they think monetary policy is in a good place, i.e., the cutting cycle is towards the end. The Fed held rates at 4.25 to 4.5%, but there were two dissents. And that is the first time that's happened since the mid-80s, I believe, and the pressure is growing on Jerome Powell to cut rates. The Bank of England cut rates to 4% in a contentious vote, with voting 5-4, four members voting to hold rates. UK inflation is above target and currently rising. The Bank of England also denied that QT was raising long-term borrowing costs, putting it down to macroeconomic factors, and has vowed to continue with QT, which is bad for UK long-term borrowing costs and for the government finances. The big news elsewhere was that non-farm payrolls in July came in soft at 73,000, but the numbers for May and June were revised down by an enormous 258,000. Trump called the numbers politically manipulated and fired the head of the Bureau of Labor Statistics. There is as yet no replacement. So the politicization of US institutions continues under the Trump administration. UK inflation came in hot, sadly. So some charts relating to the news. Well, this is a sample of the latest tariffs on some of the US's trading partners. So Mexico, 25%, China, 30%, Canada, 35%, India, 50%, Switzerland, 39%, Brazil, 50%. These are quite big, but they're making the US quite a lot of money. Chart of the latest tariffs in the US and how they've evolved over time. Pause, take a look, try and keep up. It's difficult. So this is a chart showing the average tariff on various categories of goods into the US. You'll see consumer goods have got the highest tariff, average tariff attached to them. We've got a section coming up on how those have affected US inflation so far. And these are the effective tariffs on different countries. Now, although the headline tariff, for example, on Brazil is 50%, its effective tariff is only 8.8%, as most of its exports are agricultural products which attract low tariffs themselves. China has an effective tariff of 40%, although there's got a 30% baseline tariff. There are also category-specific tariffs which raise it, which are stacked. And these are the tariffs on individual categories of goods. You'll see that iron and steel articles get 40%. So all these tariffs are very complicated, and keeping up with them as an exporter is difficult. They change all the time. And for example, the 50% tariffs on Brazil, which Trump has announced as retaliation over the prosecution of his ally, former right-wing President Jair Bolsonaro, there are 700 categories that are exempt from the tariffs, but they still apply to coffee, beef, tropical fruits, seafood, cocoa, and sugarcane, etc. It's difficult, navigating all this extra bureaucracy adds uncertainty, cost, and paperwork. But it's all raising a lot of money. We've talked about this in the last episode, but it keeps on rising. In July, tariff revenue hit 29.6 billion. That's 350 billion a year, or 1.1% of GDP. Reminder, tariffs are a domestic tax. They're not paid by the exporting country. They are paid by US importers. So the US fiscal deficit in 2025 was forecast to be 1.9 trillion. So that tariffs would reduce that by around 20%. So that means, although the fiscal deficit is still enormous, it will shrink by around 20%. And these are the OPEC plus production targets. Although quotas have increased by 729,000 between March and June, actual production only increased by 543,000, almost all of that from Saudi. So you'll notice that Iraq's production quotas increased 62,000, but its actual production fell by 45,000. So that raises the question, how realistic are OPEC's production estimates? It would seem that actually Iraq is producing at
I think
capacity.
Iraq had an attack on one of its refineries.
Right. Okay.
I
That'll be.
think, and that may be why that number is low.
Yeah. But Russia, for example, allowed to produce an extra 97,000, only produced another 55.
Yeah.
Kazakhstan has been punished for cheating. So the latest news on chips is Donald Trump is thinking about allowing AMD and Intel to export their high-end AI chips to China as long as they pay an export tax, which would boost, government tax revenues. But China is attempting to develop integrated circuit independence, and you'll see that its domestic chip production has actually been growing quite rapidly. So all this will tend to accelerate Chinese technological developments because they can't rely on the US. And briefly on to Stephen Millen, who has been appointed, who Trump has appointed onto the board of the Fed. Whether he actually gets there or not is subject to Senate oversight. But he believes that income tax and tariffs hikes under the Trump administration will generate enough economic growth to shrink the deficit. We have been here many times before. Sell side is what's it supply what's it called, supply side economics under Reagan. It never works. And he believes that tariffs will not cause lasting inflation. He is expected to support a cut in interest rates. Okay, and on to the data. Equities, Richard.
Thank you, Keith. So what period are we looking at here, Keith?
Oh, sorry, this is the period since we last reported, so it's a month.
4 weeks. So, okay, so this is the change since 4 weeks, as opposed to a weekly change. So I think the year-to-date change, the FTSE All World and FTSE All Shares up 12% and 11% respectively, and the Stoxx 600 and S&P 500 both up 8.3% year-to-date. The Russell 2000 pretty much unchanged, with the Nasdaq up 10% year-to-date and nearly 5% in the last 4 weeks. Everyone is predicting the Nasdaq is ripe for a significant drop. It's not showing any signs of it yet.
Yep.
The Hang Seng is up 24% year-to-date, 4% in the last month, and the Topix up 10% year-to-date, 8.5% in the last month. Bitcoin up nearly 30% year-to-date. It's had a good last 4 weeks, 9%. And then the dollar index has basically been bouncing around, doing not very much, I think, over the last 4 weeks. And the year-to-date changes of 7.2% for the pound against the euro, against the dollar, 12% up for the euro against the dollar, and the dollar index down 9.2%. So
Yeah.
the dollar significantly weaker at the start of the year. The VIX is down 6.3%, which coincides obviously with the relative strength of the US stock markets.
Yes.
So we have charts of the FTSE All World Equity Index.
Looks good, frankly. Equity's doing well, despite all the tariffs and the uncertainty.
There are chartists seem to be calling more and more for a significant decline in the US markets. There's FTSE All Share. I'm not commenting on whether they're right or wrong. I just noticed that there seems to be more of it. The Euro Stock 600, S&P 500, the Nasdaq looking very strong since its April dip.
Well, it's up an absolutely astonishing amount since its April dip. So the Mag 7 are up something that. So we've got a chart later showing tech mega caps are up 49%, and that's driving the whole of the US market. When you look at the Russell 2000, which is mainly small caps.
I was listening to a webcast yesterday, and they said that the S&P 493, in other words, the 500 minus the 7, is up 2% for the year.
Yeah.
There's the Hang Seng, which is has done very, very well since the start of the year, up 24%.
Yeah, which is amazing, actually, given the trade war. Frankly, we'll take you through the Chinese data. The Chinese economy is not doing very well. I mean, the equities and economic fundamentals really seem to have decoupled for now.
There's the topics, and the weekly change of 8.5%. Well, actually, it's the last four weeks change 8.5%.
Yeah,
10% change year to date. Bitcoin now 118,000.
Yeah, Bitcoin grinding higher. Amazing. Look at that. Doubled, more than doubled over the past year.
Yeah. There's the pound against the dollar, the euro against the dollar, and the dollar index.
So which is, Trump has succeeded in weakening the dollar, and that is good for exporters.
He has. And we have the VIX back down to its very low levels.
Yeah. Complacency levels, frankly.
Yeah. So VIX seasonality. Are we heading for a spike in volatility in September and October, November?
Yeah, traditionally October is the time when the market crashes. Not
traditionally,
not a prediction, but here's hoping.
And earnings season has been strong with lots of positive earnings surprises.
Yeah, absolutely, amazing. Not what I was expecting given tariffs. We'll take you through all that.
And 83% of S&P 500 companies have beaten earnings estimates.
Yeah.
So the US economy, I know there's a slowdown in employment figures, although they're quite clearly they're subject to much debate. But the US economy is still doing quite nicely. Thank you very much.
It is. Now, corporate profits have been surprisingly strong.
And US corporate profits margins still rising from an already high level.
Yeah, absolutely.
Much higher than Europe.
Yeah. It implies that there are monopolies in the US that are exploiting consumers, essentially, because profit margins should be mean reverting. New companies should enter the market and exploit those supernormal profits.
Yeah.
They're not.
No, well, in the case of tech, they're being bought, aren't they? So,
yeah.
And everybody has stopped talking about the potential for a US recession. Clearly, it spiked high with the arrival of Trump in office, where there was doom, gloom, and despondency. That has not come to pass. Certainly not yet. Here we have US stock valuations significantly risen after the April collapse. Mega cap stocks up 45%, as Keith said, since their April lows.
Yeah. So I said 49%, but it's 45%. It's still a lot.
And then we have Nvidia and Microsoft accounting for 50% of the gains of the S&P 500 between them this year. Meta, a mere 10%.
Yeah. So basically, in order to get the same return as the market, you need to be heavily weighted into tech.
Earnings growth, the S&P 493, barely beating inflation. So all of the growth is in those big, virtually all of the growth is in those big seven.
Yeah, absolutely. The earnings growth of 493 is, inflation. That's it.
And there's a lot of buybacks still going on, which is supporting the pricing in the market. And everyone is long tech, market cap ratings. Tech is by far and away the most popular sector, which of course explains why the price is rising. It's a bit
Precisely.
of a sine qua non.
Yeah.
And selling of small caps, which is why the Russell 2000 is not going anywhere.
Yeah, this is quite sharp, though, isn't it?
I mean, this is sort of bubblicious territory, isn't it? And that's
is.
what people are saying is the tech bubble going to burst? The problem with the tech bubble bursting is that they are earnings positive and their earnings are very strong.
Yeah, that's true for Nvidia, etc. I again question how long that will last. Because so as an aside, the my wife is involved in this project to detect Asian hornets in this country, and they've got some tech guy who's put these cameras into traps, and they're training the AI to identify Asian hornets. I mean, it's really good stuff. But the cost is in training the model to identify Asian hornets. When they've developed the model will go on a little SD card, and you won't need to access ChatGPT or whatever at all. So you only need the AI to train the model. You don't need it when it's, the model is taught. So I wonder, the extent
Yeah, the
of
extent of recurring profits as opposed to
yes,
one-off.
yeah,
I mean, the
absolutely.
business model is still being evolved, isn't it? And at the moment,
Yeah,
they're hugely expensive to create and train, and the data
yeah.
centers are very expensive to run.
And we seem to have forgotten all about DeepSeek. The fact you can develop
Yeah,
these AI models with much less computing power.
the options retail market as a percentage of the total is now 23 or so percent, and that has risen quite
Yeah.
dramatically, hasn't it,
Yeah.
since the early 2020s.
I'd suspect the vast majority of these people lose money.
So there's an article that I was reading this morning about Jane Street and its penetration of the Indian stock market and manipulation versus good management and so forth. And the Indians aren't very happy with Jane Street. But basically, 93% of Indian private traders lose money on options.
Yes, I'm sure. Absolutely. Options are expensive.
Yeah. Palantir. Oh, if only we bought Palantir, Keith.
Well, I know. Yeah. So this type of thing, to my cost, I never get involved with this nonsense. But, I wish I had.
Palantir are quite deeply into militarization of AI, aren't they?
They are. Yeah, they'll come after me for my skepticism now. There'll be a drone outside the window.
No, it'll
Um,
be an attack dog, I think.
a P ratio of 621. Price
Oh,
to
is that
sales
all?
ratio. Sorry? Yeah. Price to sales ratio of 67. Do you remember Sun Microsystems,
Yeah.
talking about the price sales ratio of 10 and how ridiculous it was? Yeah. Here we go.
Tesla.
Yeah.
Well,
So despite doing a section, a couple of episodes ago about Tesla and how it's falling out with Trump and that was going to be a disaster. There you go. Doesn't matter. Trump has got 29 billion share options award, dilutative potentially, keeps
Yeah,
on rising.
yeah.
Sales are falling, profits evaporating, market doesn't care.
Bubbles can last a long time. Chart of railroads.
Yeah,
Now that, goodness me, that declined from a lot to not very much, didn't it?
it did. But the bad news for us, Richard, is like the bull market lasted, what, 50 years?
Yeah.
And then the bear market lasted 100. So, well,
We need those time capsules, Keith. We need to start getting those out.
yeah. And while we talk about equities, let's return to the Kalecki-Levy model of profits. Where do corporate profits come from? And a reminder, corporate profits equals investment plus dividends minus household savings minus government savings, i.e. deficits are good for corporate profits. Positive government savings, a positive fiscal balance is bad for corporate profits, minus rest of world savings. So, how will Trump policies affect corporate profits via the Kalecki-Levy model? Well, the One Big Beautiful Bill Act reduces tax liabilities for capital investment and encourages private sector investment through full expensing of capital expenditures in equipment structures and R&D. So the technology and healthcare sectors are likely to benefit from upfront and retroactive deductibility of R&D expensing, i.e. good for investment, good for corporate profits. The energy and industrial sectors should also benefit from 100% first year depreciation expensing. So again, very good for investment. So if we just run through this, investment, positive. Dividends, not sure. To what extent will companies absorb tariffs hitting their profits margins? Not sure. Household savings, again, not sure. How much will individual absorb tariffs? Government savings, actually neutral to positive, i.e. there would be an increase in savings because the deficit is actually likely to shrink slightly because of the effect of tariffs. And as we took you through earlier, the 350 billion a year run rate that the government's raising from tariffs. Rest of world savings, negative. So that will tend to be positive for corporate earnings because the trade deficit will shrink because of tariffs, the effect of tariffs. So here we have the balance of trade, which has shrunk slightly, I think you'd say, and is likely to shrink further, question mark. CapEx investment has been absolutely extraordinary. It's a key driver of corporate profits, and it shows no sign of stopping. So there's massive investment in AI data centers. Now, is that a bubble or not? It's certainly speculative, but you'll see investment in offices has been falling, investment in data centers has been rising in compensation. So bottom line is, according to the Kalecki-Levy model, it's difficult to discern really whether the effect of Trump policies are going to be positive or negative on corporate profits. What it's certainly going to do is boost investment. Tech AI investment is a real support for both the economy and US corporate profits. And as long as that continues, corporate profits can remain strong. But in my opinion, it can't last forever, Richard.
Yeah, I mean, that rate of investment, as you say, can't last forever. And it does look a bit bubble-ish, doesn't it? And a lot of these data centers that are being built won't come online for a couple of years. And I suspect what's going to happen is the market will actually be flooded with them, and a little bit like the undersea cables, the
Yeah.
of the under the Atlantic cables, where far too many cables were laid, and I suspect, and then there'll be some capital write-downs,
Yeah.
quite big write-downs of the investment, and it's just a sort of classic boom boom bust cycle. I actually don't think it's a particular threat to the US economy because it's investing in future technology, which is going to be very important. But I also think you're seeing the I think actually you're seeing the competitive market working sort of at its best, really. And I actually wish that we were building a few. In the UK we had some of this dynamism that the US has, and I think the UK and Europe are falling further and further behind the US.
Yeah. Have you seen our electricity costs, Richard? Yeah. Bottom line,
There's an article in the FT this morning, Keith,
Ready?
did you see it, about Scottish wind power? So 37% in the last 6 months, I don't have exact details, but something like 37% of Scottish wind power generated in the last 6 months had to be dumped, and the suppliers paid for not producing it. And they're still continuing to put more wind farms in Scotland, and there is no way of getting transmitting the power down to the big cities of England. So it's talk about malinvestment. We're bloody windmills, and the US are building data centers and building out AI technology. It's like,
well, we need to build more transmission, but the planning system in the UK, NIMBYism.
And we have no money because government's taking it all and spending it on things it shouldn't be spending it on.
Well, I agree with that as well. But we will have some positive stuff to discuss.
Surely not, Keith.
I think. Good news section. The good news section is very short and towards the end, but hang on.
We may never get there.
And on to commodities and energy. But quick summary first. So energy was generally weak except for coal. OPEC opening the taps, and the sort of decline in tension in the Middle East has meant oil prices have fallen over the past month. Industrial metals are extraordinary. We'll take you through the details. Copper down big. Lithium and neodymium have gone through the roof. Precious metals continued strength. Rhodium, again, extraordinary month, shooting up. So energy first. Brent down about 4.4% over the past month, down 10% on the year. Great news for consumers. Dutch natural gas down 5% over the past month, down 35% year to date. Great news. It is, of course, the summer, so you would expect gas prices to be down compared to January, but still, that's good news. UK natural gas prices also down 35% year to date. US also down 10%, down 20% year to date. Now, if data center building continues, then you'd expect US natural gas prices to head back up. Coal up 2.2% over the last month, still down 10%. Uranium down 3%, pretty much flat over the course of the year. This is Brent. So OPEC opening the taps has not caused the price to collapse, but it is weak. This is WTI. Some numbers specific to the oil market. Well, the US market remains oversupplied in that you've had inventory builds of the best part of 20 million barrels over the course of the last month. So the US is oversupplied. But interesting, US oil production appears to have reached a near-term peak. It has fallen by 150,000 barrels a day over the past month, and the Baker Hughes rig count is continuing to fall and is down 71 since the start of the year. Now, if you look at oil production in the US, that looks to me like a near-term peak. Now, in order for that to start rising again, given that most of US oil comes from shale, you need to put rigs back into operation. And we've seen the rig count is falling. Now, it takes about a year from a newly drilled well to come into production. So I think we're baking in falling US oil production for the next year. Whether it comes back up again will depend on the oil price. If the oil price rises enough to incentivize drillers to get back into the market, then it can keep on rising. But right now, with rigs coming out of the market, you expect to see US oil production falling. It is the natural cycle. This is EU natural gas futures. That is a pleasing chart back down to its lows. UK, similar. That is good for inflation. US natural gas futures down again. At this time of year, actually, you normally expect to see it rising because of summer air conditioning demand. Now, this is US utilities building new power plants to meet data center demand. That should be good for natural gas. Coal is up from its lows. Is it rolling over? Difficult to tell as yet. Uranium has reached stability, I'd say. Richard, industrial metals.
Thanks, Keith. So these are the changes over the last month. So aluminium pretty much unchanged, as is cobalt. Copper, as Keith mentioned briefly earlier, down 21% because of this tariff issue. And year-to-date change now 11.5%, which is really the underlying change in the price of copper, ex tariffs.
Yes.
So it's still having quite a strong year so far, but clearly nothing like it was a couple of weeks ago. Iron ore almost unchanged year to date, up nearly 7% over the 4-week period. Lithium up 23% in the last month, bringing it up to 4% year to date. So has its decline started to reverse is the question there. Neodymium up 32% in the year to date, which is massive, and 17% in the month. I'm guessing that is partly due to the furore over rare earth metal supply from China and the fact that the Chinese are limiting supply and using it as a weapon to counteract US tariffs. Nickel unchanged year to date, tin up 15.6% year to date, and zinc down year to date. Supply increases have driven down the prices, particularly for battery metals. And you can see there that the average annual price for rare earths has dropped dramatically, but I think that is now picking up, isn't it?
Yeah, I mean, reminder that rare earths are not particularly rare. It's just we haven't really gone looking for them, and they're quite expensive to extract. But we can diversify away from China if the price is right. It just takes a few years.
Yeah, rare earths are a category of element in the periodic table that are called rare earths, and they, as Keith says, they're not particularly rare. They're quite difficult to refine, and that's the and to separate. Some of them have very similar chemical properties, so they're quite difficult to purify.
Yeah.
And you have to set up quite significant manufacturing plants to do that, and you get a lot of toxic byproducts, so they're not easy things to deal with.
Yes. Yeah, that is very true, Richard. In China, they just dump them in a toxic lake.
Yeah, Chinese don't care.
Yeah.
Which is wrong, clearly. Yeah. But, so they have aluminium, which has been on a strong run actually since March, April time. Cobalt.
Yeah. So basically, the price of cobalt has risen because the DRC has restricted exports, but that won't last forever.
Copper, I mean, the rapid pre-tariff build-up and then the rapid post-tariff drop.
Yeah. I mean, this is just emblematic of the chaos that Trump is causing in markets all around the world.
Iron ore.
This is interesting, actually. This is iron ore in the US. Is that so? That must be tariff effects, surely.
I don't know, Keith. What you can see is there's been a downtrend for probably 6 months, hasn't there? And now that downtrend has reversed, and it has not. The reversal hasn't been jumping around all over the place. It's been quite steady.
Yeah.
Maybe there's sort of industrial construction demand.
Well, but the thing is, now that the tariffs on imported steel are coming into effect, you're seeing domestic price of steel rising.
Yeah.
I think.
Yeah. Lithium, which has had a very big bounce since June of
This is
And
absolutely extraordinary. So this is since we last reported. It's just gone through the roof, up 23% over the course of the last month. So let me read this out. Lithium carbonate prices rose past 75,000 yen per ton, yuan, sorry, per ton in August, nearly erasing this year's slump as the possibility of lower output from key mines countered oversupply worries. The Chinese government pledged capacity cuts to major industries that have suffered from deflationary pledges in recent years, driving investors to bet on an outlook of lower lithium supply as the world's top refined lithium producer. Expectations of an overhaul to mining policy gained traction after the world's top battery producer, CATL, suspended activity in its whatever mine after failing to extend a key mining permit. The mine was responsible for around 5% of supply. So essentially, the Chinese reacting to the collapsing lithium price by restricting supply.
there's neodymium, which, as I say, must reflect the ongoing argy-bargy between the US and China and
Mm,
the rare earths.
yeah. Well, the thing is, this is the price in yuan, presumably the price in China. So the Chinese market is presumably has a lot of rare earths because they're not exporting them. So, I don't know.
Yeah, I'll pass on that one, Keith. It's an
Yeah.
interesting point. Nickel, tin, zinc, and on to precious metals. So the last 4 weeks, not very much change actually for gold and silver, really, a little bit down for platinum. As Keith said earlier, 26% increase for rhodium in the last 4 weeks is massive. And but year-to-date changes are hugely significant. So we've got 27%
Yeah.
for gold, 31% silver, nearly 50% for platinum, 54% for rhodium, 28% for palladium.
Yeah.
So really big changes there. There's gold, which is, I think, on the verge. Well, on the verge, I think this chart is setting up for another step higher.
Very good.
And rapid increase of household demand for gold ETFs in China, putting pressure on the price of gold.
Yeah, these are big numbers actually. Yeah.
Yep.
6.5 billion in 1 month.
Yeah. Silver, platinum, rhodium, just that really big spike.
Yeah, that I've looked for trading economics did not seem to have an explanation for it.
And palladium, which spiked right up and is now dropping down again.
And on to rates. Thank you, Richard. Well, frankly, not much change over the past month. The UK yield curve still has this big upward slope. So now expecting a minimum of 3.75%, and then 30-year you're getting the best part of 5.5%. The US yield curve is more normal, I'd say. Still expecting more rate cuts and positive slope. Goldman Sachs is expecting global interest rates to keep falling over the next year and a half, but the pace of cuts to slow. And the global bond bear market has now in its fifth year, which is the longest market drawdown in since the 1970s. In the UK, the bad news is that pension funds and insurers are now going to be steadily selling gilts in the coming years. This means yields are likely to be higher in the future than they would have been over the past few decades, unless government rules change and force them to buy gilts as they haven't done in the past. The problem is that most defined benefit schemes are now in drawdown, wind down, and so they'll be selling off assets to pay for their liabilities, but presumably they will tend to be selling short-dated gilts. And that has big implications for yields. If pension funds lower their demand for gilts by 19% of GDP, the overall interest rate on government debt would rise by about 0.8%. This would increase debt interest spending over the next decades by around 0.8% of GDP, were per annum, were total government debt to remain at its current level. Now, 0.8% of GDP is huge in context of a government which spends around, is it 43% of GDP? So you're talking about, what's that, an extra 2%? So in order to keep the fiscal deficit under control, you'd need to raise taxes by about 2%. Not good. Of course, the last month, UK 2 years been pretty stable. 10-year, not going anywhere. Essentially, in order for UK long-dated yields to come down, you need progress on inflation. And so far, we ain't got none. US 10-year actually down from its peaks. German 10-year, right? I'd say that's rising, actually.
Yeah, gently rising, isn't it?
Gently rising. So the fact the ECB has stated that it's towards the end of its cutting cycle. I think Eurozone bonds everywhere rising currently. Sorry, that was France, Italy, Greece. And on to economic data. Now we have a hell of a lot of it. We've got a month's worth. So I have cut out most of the survey data and concentrated on the hard data. But even so, we'll try and push through this. Summary. UK stagflation, EU stagnation, US fine but slowing. Inflation has risen, but really there's very little sign of pass-through from tariffs, much less than I would expect. We have some sections on that coming up. China stagnation, i.e. the inflation is zero, literally zero. On to the UK, Richard.
Thanks, Keith. UK interest rates, excuse me, currently 4%, as we've discussed.
Yeah. So the further cuts in interest rates will require UK inflation to start coming down. It is currently heading in the wrong direction.
Yeah. UK CPI 0.3% in June, so ahead of expectations and significantly too high.
Yeah. Every month when inflation is too high, it's due to idiosyncratic and exceptional items.
One-offs.
Yeah.
Yes. Year on year for the UK, 3.6%. The trend is undeniably up. So we had our first, because there's just the two of us, we do Sainsbury's online shop every couple of weeks. We had our first over £200 Sainsbury's shopping bill ever the other day.
Was that 4 bottles of champagne, Richard?
Sainsbury's is cheap, Keith, it's 5. It's just a real line in the sand, isn't it? You know, it used to be 90 quid and you'd struggle to get to 110.
Yeah. Well, frankly, I do most of my shop in Aldi these days. And then I go to Waitrose or whatever.
Do Aldi do what? Delivery?
No, I physically go there.
Anyway, you know, it's this concept that inflation is under control is a canard, isn't it?
Mm.
So core CPI 3.7%.
And even the most optimistic observer could not say that was coming down.
No, you'd have to say it was actually gently going up. RPI month on month 0.4% and year on year 4.4%. And bearing in mind, these are all massaged inflation statistics that have over the years been massaged to make inflation look lower than it really is, not higher. Mm. So maybe we need Trump. Oh, actually, we need Trump to come in and shake up the Office of National Statistics, don't we? Because they're a complete disaster area.
Oh, that is true, but I'm not sure appointing somebody who's just going to get out his crayons and draw everything lower is a good solution.
So there we are. The UK is doing jolly well. This is a race to the top, isn't it, Keith, for this one? This is
God. Yeah. Actually, yes, we need to reinterpret this. Something that Britain is good at,
yes.
beating the world in inflation.
Service inflation is not falling and goods inflation is rising.
Yeah, not great. So this is the OBR's inflation forecasts, basically. So they're forecasting that inflation will rise again in Q3, and then from Q4 will start coming down back towards
Keith,
target.
there's one of those more than 90-degree declines
Yeah.
that we used to have every week.
Yes.
Series thereof.
Yeah. Not great. So previously, before the June inflation numbers, which obviously were high, the Bank of England was forecasting that UK inflation would peak at 3.7% in Q3. They're now saying it'll be 4%.
I think if you actually put the question into Chat GPT 5, the latest version, and you pay for it, what's the prognosis for UK inflation? It actually comes up with your and then a four-letter word.
Yes.
The Bank of England not expecting UK inflation to return to its 2% target until 2027. So, I mean, you have to question whether it's really a target, don't you, or an aspiration?
That's well put, Richard. But what I really, really did not like about this was services inflation rising again.
Yeah.
That's bad.
I have to say, the UK inflation is completely out of control. I don't think the government understands what's going on. There was an article in something yesterday, probably Sky News, about the use of food banks by middle-class people who have two jobs, but they can't afford food. We are in a much, much bigger mess than the politicians dare let on. And the solution to it is not to increase taxation.
Yeah. You've seen that the increases in CGT, capital gains tax, actually succeeded in reducing the overall tax take from CGT. When you raise taxes above a certain level, people do everything they can to avoid them, and that is what's happening.
Yeah, and the fact that we're starting to hemorrhage wealthy people who contribute to the consumer economy, but also invest in the UK, build businesses in the UK. I mean, they've taken a shotgun and blasted through both their feet.
Mm. But so what this chart is showing, and what we've talked about extensively in previous episodes, is how the way the UK government has raised taxes has raised inflation as well. So working against Bank of England monetary policy. So rising employment taxes in particular led to pass-through effects, but also administered price changes, so bus fares, vehicle excise duty, etc., have all meant that UK inflation has risen more than in other countries.
And in the UK, vacancies have been falling for 3 years. I mean, we do have a serious problem with the ONS in that it appears to be in complete disarray.
Mm.
And you have to take all of their data with a large pinch of salt. But this is suggesting, isn't it, that we are, as Keith said earlier, moving towards stagflation. UK average earnings growth is flat to falling.
Yes, this is good news. Data out this morning.
Average earnings growth, excluding bonuses, also falling.
Well, actually, it's flat. I'm puzzled by this. So,
well, it depends what your timescale is, I suppose.
Yeah,
Keith,
that's true.
isn't it?
That's true.
But
Yeah.
but it's high. I think the problem we've got is that people are experiencing serious damage to their disposable income levels because of fundamental price inflation, and average earnings growth is high because of that reason, and we are in an inflationary spiral.
But in a free market, a weakening labour market should reduce earnings growth and inflation should come down.
Yeah, and it's not yet. Public sector pay growth has been higher than the private sector. Service inflation was 6.8% in the year to May. Let's call that 7%, shall we?
Yeah. Well, I'm not saying, if you're going to raise the minimum wage by 12%, what do you expect? This is a sector which employs lots of low pay,
Yeah,
low skill minimum wage workers.
yeah. UK unemployment rate, actually been on an upward trend now for 3 years.
Yeah. Again, do we believe these numbers? I mean,
Probably believe the trend.
yeah, this volatility
Yeah,
that's just nonsense.
yeah. And the 3-month employment change, I don't think you can read a huge amount into that.
Well, again, the numbers are just, they don't make any sense. So this is from the Labour Force survey, which we know has a low response rate. And those were the numbers to June and May.
Yeah,
Um, the HMRC payrolls data, which is to July, but always very unreliable and subsequently revised heavily. But if you look at the numbers for April, May, and June, they're saying HMRC payrolls fell by 64,000. The Labour Force survey is saying over that period they grew by 238,000.
so given that HMRC make revisions to their data retrospectively, I suspect HMRC is much more accurate than the
Labour Force.
payrolls data, the
Yeah.
ONS data.
No, I agree with you, but
But yeah,
all those jobs are in the casual sector.
the gig economy. Yeah,
Yeah.
the UK claimant count is falling.
Yeah. So that would tend to suggest that people are finding work in the how would we put it, casual sector,
Yeah,
not on HMRC payrolls.
yeah. GDP growth down 0.1% in May. Anyway, it's not good, is it?
No, it's not good. 2 months in a row shrinking.
And year on year, it's like we.
Yeah. Yeah, absolutely. Nout.
Industrial production down in April and May, month on month and year on year. Retail sales got in May down 2.8% month on month, and a little bit of a respite in June. Net mortgage lending, this has all been skewed dreadfully by the stamp duty changes. But we seem to be, having got through that, we're probably going to settle down to a more normal type of mortgage lending.
Yeah, that looks pretty good to me.
Yeah.
Actually.
Consumer credit is looking fairly stable.
Yeah, this is always double-edged sword. Are people putting money on their credit card because they want to or they have to? Question mark.
The lending to individuals, again, that's skewed by the stamp duty, but it's settled down again to a healthy level. Unless, as Keith says, they're doing it to survive, and what are they going to do when that runs out? UK construction output was 1.2% in May.
Yeah, not great.
Manufacturing PMI in the high 48s, and the services PMI is at 51, which is a bit lower than expected.
Yeah, that's actually quite a large drop, but it is volatile, this.
Yeah.
But not very encouraging for the UK economy.
No. The composite PMI there is at 51. Construction PMI 44, so that's dropping sharply. Does look like it's heading for new lows.
It does. That's the lowest in these charts were only 3 years.
Yeah.
The S&P Global only give us 3 years of data. If you want more, you have to pay.
Balance of trade. It's setting. It's looking bad, isn't it? Public sector borrowing requirement looking
bad. This is partly caused by higher interest rate costs. So, higher inflation uncertainty is feeding through to higher gilt yields, which is feeding through to bigger PSBR. We need to get inflation under control sustainably to get yields down. Watch this space.
Or we need to cut government expenditure,
Yeah.
or preferably both. The economic surprise index, nothing surprising there.
Yeah. Bit shit.
Indeed, jobs postings index 78.1.
Yeah, it's kind of flattened off the last month, actually.
Yeah. UK wage growth, which we've discussed, 5.5%.
Yeah. Still, so advertised wages still very high, still way too high.
So hiring activity appears to be slowing sharply, and
Yeah. Now this should bring wages under control,
yeah,
he says.
and the UK labour market is gradually weakening. Ratio of unemployed people to vacancies has doubled, hasn't it, in the last 3 years?
So why hasn't wage inflation come down as in other countries? The only explanation must be that it's because of the rises in minimum wage, which are feeding throughout the upper echelons. If you raise the minimum wage, then the person just above it needs to also have a pay rise to keep his wage differential.
And so on it goes,
Yeah.
And obviously wage growth is much too high to be compatible with a 2% target, and it's not dropping quickly at all.
Yeah, it's much higher than in other countries.
UK car and van production hit its lowest level since 1953. That would be 80 years ago.
Yeah.
80 years ago.
Yeah, moving swiftly on.
Yeah. Average worker in the UK paid relatively low rate of tax by international standards. Don't tell Rachel Reeves that.
Well, the reality is that actually we have reduced over the past decade, reduced the average tax rate for the average worker. And, you keep on saying tax the rich. Well, we're taxing the rich really quite heavily.
So this is wages paid in tax to the average worker.
Yeah.
For a single family earner.
Yeah. You see, France pays much higher rates, etc. So there is scope to raise taxes on the average worker. But, is that politically possible?
I mean, the other point I think, Keith, is none of these countries are in rude economic health. And so the comparison is valid on a superficial level, but if you do a comparison in terms of economic vibrancy, I'm not quite sure what the results look like then.
Well, I don't think they're doing badly. Sweden, that'd be an interesting question, Richard. But I don't think there's much correlation actually. So obviously, it also, we're only looking at a single variable. The point about these high tax countries is they also have very strong social capital. So people, you hire somebody to do a job, they're going to do a very good job, as opposed to, doing it as quickly as they can, then bogging off for lunch.
So the OECD tax wage by income level for each country, we are in the middle.
Yeah.
So UK tax rates be surprisingly stable over time. But this is tax rates, but not overall tax take, isn't it?
Yeah, but
because we have an awful lot of stealth taxes.
That's true, but this is no, this is the overall tax wedge, I believe. So how much for the average worker, single worker, they're paying out of all taxes. You'll see it was much higher when it was 2% higher in the mid 2000s when our fiscal balance was better.
So Bank of England cuts rates to 4%, but it was disputed. So it's unlikely that there will be many further cuts, I think, until inflation has to be brought under control. The Bank of England hasn't got a clue about its inflation forecast, just like it didn't have a couple.
So can I come in on inflation, actually, Richard?
Yeah.
So, I mean, obviously, I've been expecting inflation to come down, and it basically hasn't, and it's heading in the wrong direction. But as we've taken you through these charts, it's clear the labour market is weakening. in particular, that chart of unemployed people to vacancies is rising and rising quite quickly.
Mm,
That should all bring UK wage inflation down. Services, the majority of UK inflation. If services inflation comes down, UK inflation will come down, and most of services is wages.
mm.
But that all depends on the government not mandating extraordinary extra rises in the minimum wage and not raising taxes in a way that is inflationary. If you increase employment taxes, then employers will attempt to pass that on through higher prices. If you raise income taxes, then you reduce consumption, and that is disinflationary. What?
I don't actually agree with that, Keith,
Go
because if
on.
you raise income taxes, employees sue for pay rises. And
Okay.
so
Yes.
I think that any tax increase is inflationary. The only difference is we don't include PAYE, we don't include personal tax in the inflation figures. But since the inflation figures are meant to reflect
Mm.
your disposal, the availability of your disposable income, and that we are misrepresenting the situation. And in fact, inflation is significantly higher than these levels because of increases in employment taxes.
Well, I disagree with that, Richard. I think that you can't include tax rates in inflation numbers because actually what matters is the price level for goods and services in the economy, and that
Well, it
is
depends what you're trying to measure, Keith. So if you're actually trying to measure what people experience in terms of their disposable income, which
right.
then you should include tax, tax, all taxation in.
Mm. Well, I think that's a separate issue, Richard. Their real disposable income.
I think that's a fair point, Keith. Yeah.
Yeah. Anyway, in summary, stagflation
Yeah.
and yeah, both numbers going in the wrong direction. Inflation going up, GDP going down.
Yes. Productivity going nowhere.
Okay, so while we're talking about the UK, and apologies to the Discord member whose name I forgot. This is about a month ago, before I went on holiday. We had a discussion about UK wage growth and inflation, and he was pointing out that wage growth in the early 2000s was high. Actually, is comparable with wage growth about now, but inflation was much lower than it is now. And so he was saying that why should high UK wage growth necessarily lead through to higher inflation? Why can't we just return to the early 2000s when we had high wage growth and subdued inflation? Well, sadly, the answer is productivity. And so this is UK labour productivity year on year. And you see in the 2000s, we had productivity about 1.4% per annum. Now, his current value is negative, which is quite an achievement, frankly. Let's call it zero to flatter ourselves. So, productivity growth is the change in total output divided by total hours worked. Wage growth is change in wages divided by total hours worked. So, what you want to know is how much more people are earning for given unit of output. And that equals wage growth divided by productivity growth. And so higher productivity growth allows higher wage growth without producing inflation. So bottom line is low UK productivity means that high wage growth leads through to inflation. Bottom line, if we want higher wage growth without producing inflation, we need to get productivity up. And
And
gone.
I was going to say, and getting productivity up requires investment.
Yes, precisely. And actually, what the US have done in allowing, early depreciation of investment, that encourages investment.
Yeah.
Whereas,
So what we do in this country is we punish businesses for being successful.
yes, well, we
You
need the
know,
tax, mate. Yeah.
yeah, and we don't encourage success, and that's entirely the wrong way around. And there's a sort of failure to comprehend the lifeblood of our economy, all market-driven economies are small, medium-sized businesses, and that rather than punishing them for being successful, you need to encourage them. And so we are absolutely going about this the wrong way.
Yeah. So essentially, I'd need to raise tax revenues without taxing the average worker. So neither of the main parties have the courage to raise income tax rates, means that they are piling taxes on other sectors of the economy and distorting, reducing economic growth.
There's also, I read an interesting letter in the FT yesterday, which is a very, very good point. The chap was saying, I've spent all my life paying my national insurance in expectation of receiving a pension, but only recently has the winter fuel allowance been provided. Therefore, the winter fuel allowance is an uncovered, as far as for me, this individual who's clearly about to retire or just retired, the winter fuel allowance is an uncovenanted benefit. It was never saved for, it was never charged. And of course, he's absolutely spot on. So basically what the government's done is, when they introduced winter fuel allowance retrospectively, said that we haven't taken the charge for this, but we'll give it. And this is what David Cameron did with the triple lock. He suddenly said, you haven't put in for this, but you can have this anyway. And I don't know where it's going to come from. And this is the issue of buying votes with freebies.
Yes, I totally agree. I mean, I think the Cameron government was an absolute disaster on every level. As we've talked about many times before, the worst tax in this country is stamp duty on properties, which just stops everyone moving and is a just totally unjustifiable tax on young people who buy houses. And that's the Cameron government. And once you put these taxes in, or these benefits, they never go. Anyway, rant over. Onto the EU. So the ECB the ECB held rates steady at 2.15% and said that monetary policy is now in a good place. So we look to be towards the end of the cutting cycle. GDP growth was better than expected at an enormous 0.1% month on month and 1.4% year on year. Frankly, it looks to me like all the pandemic shenanigans are over in the EU and it is returned to the previous status quo of low growth and low inflation. So inflation rose to 2%. Oh, I wish we had that here. In July, it was 0 month on month. Core was at 2.3%. Pretty good. Inflation expectations are coming right back down. Unemployment rate is actually at its lows for the Eurozone. So the Eurozone economy is doing okay, actually, in terms of employment. Industrial production in May bounced back from April. 3%, 7% year on year was actually surprisingly good given high EU energy prices and tariffs. Although, we'll wait to see what the effective tariffs are in coming months. Retail sales, 3.1% year on year, all right. Construction output, better than expected, actually. We've had this strange bump up in the last couple of months, but fading once again. Manufacturing PMI, still below 50, but rising, actually the best it's been in the last 3 years, surprisingly. Services had a bit of a bounce. Overall, the composite was 51.2. That's all right. Not great, but not disastrous. Construction PMI, though, fading. Not great. Economic Surprise Index remains positive. So the Eurozone is outperforming very low expectations. Job postings, though, in Germany continuing to decline. That's interesting. Wage growth also falling. France, the same story. So that would suggest the economy is continuing to deteriorate, actually. The labour market is. Wage growth in France down to 1.7%. The good news is that lending is picking up. And that suggests a return of confidence and growth in the EU. So that's all good news. Bottom line, in the EU, as I've said, I think the Eurozone has return to its pre-pandemic stagnation. Not much growth, not much inflation. On to the US, Richard.
Keith, US interest rates are steady at 4.25%. GDP growth quarter on quarter, 3%. Very healthy.
Yeah, that's good.
We'd
Better
like
than
some of that,
expected.
please.
Yeah.
CPI month on month, 0.3%. Bit high.
Yeah, nicked so good.
And year on year, 2.7%. Of course, CPI month on month, 0.2%. And year on year, 2.9%. But
Yeah. You're not seeing has picked up, but the tariff effect, we've got more on this and coming, but it's really minimal. Much less than I would have expected.
Yeah. So rising goods inflation due to tariffs is being more than offset by continued disinflation in services and housing.
Yeah.
Swings and roundabouts.
Well, goods is only about 35% of the inflation basket.
Yeah.
As we've talked about many times, the OER is lagging and is steadily coming down. So disinflation continues.
And only around 28% of US tariffs being passed on by US companies. But that flies slightly in the face of the increase in earnings by US companies. So I think it remains to be seen how this is all going to come out in the wash. I also think, the whole economy is a highly complex thing, and to say that if one thing happens, then it will cause something else is probably a bit simplistic, and there are more effects going on that we can't really see or predict.
Hold that thought, Richard. We've got sections coming up on that.
So fall in new vehicle prices down at the bottom of that graph, car manufacturers unable to pass on the tariffs and losing money.
Yes. So, yeah, when you talk about the effect of tariffs, and the stock market keeps on rising, but definitely having an effect on some sectors.
Yeah. Housing inflation, rental inflation is continuing to decline. Looks like it's got further to go. Oh, what does this mean?
Right. What this means is Doge has cut a load of people in the statistics department. Okay, so they are actually sampling fewer data items in the CPI calculation, and they are modeling an increasing proportion. They're imputing them from the data they've got. So Doge is eroding the accuracy of US statistics. And that is before Trump appoints the new head of the BLS, who presumably will be more inclined to give Trump the numbers he wants.
PCE inflation month on month 0.3 and year on year 2.6%. Core PC inflation month on month 0.3 and 2.8% year on year.
Yeah. Not coming down towards target.
No, but neither are they rising.
True.
Personal consumption expenditure annual 6 monthly annualized suggests that tariffs causing goods inflation to rise.
Yeah. But it's being offset by falling services inflation and housing.
Yeah. PPI month on month unchanged in June, and year on year is 2.3%.
Now, I was really surprised by this. So, factory gate inflation, I would expect tariffs to causing this to be rising. Is not.
No. We need a bit more time to see what the pass-through effect is, don't we? Core PPI month on month, 0% in June again, and 2.6% year on year.
But it's falling.
It's falling, yeah.
Yeah, amazing.
Employment costs quarter on quarter, 0.9%.
Yeah, not bad, but noticeably higher than pre-pandemic.
Yeah. Labour productivity quarter on quarter, 2.4% in quarter two.
Yeah, this is the annualized number, but given that UK productivity is zero,
yeah,
this is US wage inflation is lower, and their productivity is higher.
Yeah.
No wonder we've got an inflation problem.
And as of yet, there's no sign of AI boosting US labour productivity. which is quite interesting.
Yeah, but note, .com, all that investment in the technology, the internet, etc., didn't really have an effect on US labor productivity either. Of course, we don't know what the counterfactual is. So if there had been no .com investment, would US labor productivity just collapse to zero? Don't know.
Yeah. Unit labour costs quarter on quarter, 1.6%. Non-farm payrolls, 73,000 with a big revision in June.
Yeah, as we've discussed many times, they keep on overestimating it, but
Household survey reported a fall in employment of 260,000 in July.
Yeah, and if you look at the household survey, over the course of the last year, you'd say that there's been very little net employment growth.
Yeah. And the construction industry is continuing to add jobs, and the manufacturing industry is losing at the moment. So this is all broken down. 79,000 in education and health services.
Yeah. Now, given Trump's put in tariffs to try and boost domestic manufacturing, it ain't working so far.
Federal government employment is falling, and it's fallen by 80,000. It's not a big drop. And although Trump fired the head of BLS, the accuracy of the first estimate non-farm payrolls has been improving over time. BLS has this problem of falling response rates to the employment survey from 60% to 42%, which is clearly a problem in terms of just the absolute raw data that's coming in.
Yeah, absolutely. You're looking at the black dotted line.
And after the downward revisions to non-farm payroll, it still estimates much higher employment levels than the employment survey does. So we've got this bifurcation of data still.
Yeah, and I'd say, Richard, that there's a trend developing in
possibly so, Keith.
Yeah, the household survey.
Yep. So quarterly sets of employment wages is continuing to report lower employment growth for the non-farm payrolls. It is chart on the left. Suggesting there's a revision coming up for non-farm payrolls in the annual benchmarking, of quite a chunky one as well.
Yeah, so you've seen the last 3 years, big actual revisions, negative revisions. The non-farm payrolls massively overestimating employment growth.
Yeah, and revisions to non-farm payrolls contain information. Downward revisions tend to indicate an economy that is weakening.
Yeah, I think that's fair.
Yeah. So average weekly earnings month on month is 0.3%, and year on year is 3.9%. Average weekly hours 34.3, pretty much unchanged basically.
Yeah, but off from its lows, and decent enough number.
Yeah, unemployment rate 4.2%, so in line with expectations. Gradual rise. U6 unemployment rate 7.9%. There's a very gentle rise, isn't there, from 2023?
Yeah, there is, but it's steadily going in the wrong direction.
Yeah, and AI adoption is beginning to deflate the US labour market, with youth unemployment rising rapidly. And I think the same is happening in the UK, isn't it? It's reported that UK graduates are finding it harder to get jobs now.
Yeah, frankly, the attribution of this to AI I think is a bit of a stretch. But what you can say is that is a really quite rapid rise in graduate unemployment. Not good.
US participation rate 62.2%, so down slightly. Job openings 7.4 million, so again down slightly. Quits rate 3.14 million, again down slightly, but is it stabilized?
Don't know.
US labour market appears to be gently cooling off. And ADP employment changed 104,000 in July, and a revision downwards in June.
Yeah. So, but that's previously, last month we had said there was a steady downward trend and then bounce.
Yeah.
Danger of extrapolating data.
US challenger job cuts seem to be dropping actually from their peak that they got in early 2025. US industrial production month on month 0.3% and year on year 0.7%.
Yeah, so not great actually.
And retail sales month on month 0.6% and year on year nearly 4%.
Yeah, it's actually perfectly in line with wage growth.
Yeah. Construction spending month on month fell 0.4%.
Okay, so this absolutely mystifies me. We've been saying this again and again for best part of a year now. So construction spending has now fallen for 8 months in a row.
Yeah.
So why is the construction sector still adding jobs? I just don't get it. I mean, because that adds up to quite a lot. I don't get it.
Keith. Unless it's to do with some sort of switch into more labor-intensive construction. But I can't really see that because that would be small units.
Yeah, I just don't get it.
Yeah. Manufacturing PMI 48, so dropping back. Services PMI 50.
Yeah, that's not a good number, actually.
Yeah.
Reminder, PMI seem to have very little association with actual economic growth.
Yes. The house price index month on month down to 0.2%, year on year up 2.8%.
Yeah, inflation coming down.
Yeah, Case-Shiller index month on month 0.4% and year on year 2.8%. Building permits 1.4 million, so continuing a gradual decline, but still high in historical terms.
Yeah, absolutely. Gradual drift off, but actually not too bad.
Yeah, US housing starts basically the same. Slightly drifting down as a trend, but higher than pre-pandemic. Existing home sales low and remaining low. New home sales at a reasonable level.
Yeah.
Initial jobless claims climbing a little bit, but nothing out of the ordinary.
Totally agree.
Continuing jobless claims, definitely an upward trend there.
Yeah, absolutely. So what you're seeing is people who have left the labour market struggling to get back in. And so this is a 3-year chart, and you'd say there's a definite steady upward drift.
Indeed, jobs posting index still showing the sort of gently declining trend, although it ticked up a little bit. Wage growth 2.9%.
This is really interesting. This is advertised wage growth.
Yeah.
So actually, that's below real wage growth. So what he's saying is, companies are not offering a premium to move jobs anymore.
Yeah, downward pressure. And LinkUp continuing to report rapidly declining job openings in the US.
Yeah, so I've looked at this data, and it's true that the absolute number, this is falling. So, but and it reports basically a much sharper decline in job vacancies than anyone else does.
The weekly economic GDP estimate from the Dallas Fed 2.6%.
Good.
Atlanta Now for quarter 2 GDP 2.5%.
Good.
New York Fed GDP nowcast 2.0%.
Yeah, still all right. We would kill for that in this country.
St. Louis Fed nowcast 1.73%.
All of them up over the course of the last month. So, the US economy is not deteriorating further.
And the economic surprise index is positive. And US consumers put most of their cash into deposit accounts because of higher interest rates. So there's lots of cash sitting around.
Yes.
That could be accessed.
Yeah.
Money market funds. US Trueflation 1.8%.
Yeah, so actually just very little sign of tariff inflation.
Yeah. Home builder months of supply by stage of construction. So the housing market looking pretty oversupplied.
Yeah, but this whole thing mystifies me. We've been talking about this literally for years now. Why are they still building loads of homes when there's record supply, and why are they still adding workers? It makes no sense whatsoever.
So our summary, have a little read of it, and bottom line is the US economy continues to tick along just fine. Labour markets seem to be slowing a bit, and the policies of Trump, the adverse effects that have been predicted, aren't yet really coming through. So I think the transmission is probably more complex than we realised initially.
Well, we've got stuff coming up on that, Richard. And on to China. So I'm going to go through this very quickly. China has no inflation. So CPI is 0 in July. Producer prices still falling, down 3.6% year on year in July. Amazing. GDP growth, do you believe these numbers? 1.1% in Q2, year on year 5.2%, suspiciously close to the official target. Balance of trade, very strong. So, no evidence of reduced trade at all. Exports up 7% year on year in July, great numbers. Imports 4.1%. And it appears that although exports to the US have dropped a little bit as they have to Southeast Asia, they've risen in Latin America and Europe. So you've just had diversion rather than a drop in absolute production.
Yeah.
Industrial production is very strong, up 6.8% year on year. I do find this slightly suspicious, given we know that investment has been dropping. Fixed asset investment keeps on falling 2.8% year on year. Retail sales, decent. House prices still falling. Unemployment rate, don't believe these numbers. Industrial profits falling. Not good. Foreign direct investment still dropping at a decent clip, and it's been dropping at a decent clip for 2 years. Outstanding loan growth continuing to fall. Money supply. Bear in mind that inflation is 0, but M3 is 8.3%. So monetarists will be very disappointed in this. It shows that the money multiplier is variable and currently strongly negative. PMIs, NBS, manufacturing PMI below 50, services pretty much flat, general pretty much flat. Kaijin also saying manufacturing not doing so well, but contradicting the official numbers by saying services are bouncing back. Composite again, close to 50, close to neutral. PMI is portraying a Chinese economy which is not really doing much. I thought this was an absolutely astonishing chart.
Yeah.
This is the number of new companies being created in China. It has collapsed. So, where's growth going to come from? Do you believe the growth numbers? Certainly, this portrays a Chinese economy which is becoming less dynamic. China's summary, well, we just don't know. The quality of the data is always suspect, but it appears that China is shrugging off the effect of US tariffs for now. Low inflation would seem to indicate a weak economy, question mark. And
I just, sorry, just coming on China, they still have the overhang of their enormous property bubble. And there's no way that that's cleared yet. And I think the local authorities are in serious financial trouble because they can't sell the land that they used to sell to property developers. And I think there are some really big discontinuities in the Chinese economy that will take time, effort, and cause a lot of anguish in order to correct them.
Yeah.
No,
I agree.
They're in the middle of that process. They're nowhere near the end of it.
Yeah, I agree. It takes, in the case of Japan, it takes like 15, 20 years.
Yeah.
I expect the same.
Yeah.
And onto one chart. Now, this is the US fiscal deficit day by day over the course of the last few fiscal years. So the red line is 2025. The blue line is 2024. Now, contrary to expectations that the one big beautiful bill would increase the deficit, actually what we're seeing is the deficit is pretty much identical to last year. It's up 1.3% in nominal terms, but which is less than GDP growth. But you'll notice that actually, relative to 2024, it's fallen since April. So tariff revenues are more than offsetting the um, tax cuts and other shenanigans in the one big beautiful bill. So that implies actually there is no increase in the US deficit. So the fiscal impulse is neutral to negative. On to the effect of tariffs on US prices. So this is all from Pricing Lab, and they're looking at daily prices from four major US retailers. And what they're showing is that tariffs have had an effect, but it's been really small. So the blue line is goods produced domestically. The yellow line is imported goods. And see, prior to tariffs, imported goods prices are falling. Since then, they have risen, but the absolute effect is quite low. From October last year, they've risen 1%. And given, tariffs on China are now 30%, I would have expected much more of an effect. So if you look at domestic goods that have been affected by tariffs compared to those that are not affected, again, you can see a distinct effect starting when tariffs were imposed on Mexico and Canada. And again, there has been a clear effect on imported goods. And when you look at by country, as you'd expect, there's been quite a strong effect on China. But again, this is not very big. That's what, 2 or 3% at most. Price of goods from Mexico has actually fallen. You wonder how sustainable that is. But the bottom line is there has been remarkably little push through. When you look at the change in the price level by country of origin, there are some big numbers here. Surprisingly, UK, goods from the UK up 5%. And we have negotiated quite a small tariff rise, like 10%. China, actually, only 3.2%. Mexico, negative. So really struggling to find much an effect from tariffs. When we think about the effect on the CPI basket, goods are only 35% of the CPI basket, and the price impact on US goods appears to have been around 1.4%. So 1.4% of 35% ain't much, 0.4%. So bottom line is tariffs have been barely passed on to the consumer in the form of price rises yet, which raises the question, who's absorbed them? There are two possibilities. Either the exporters have lowered their prices, so there's been a compensating drop in the prices paid by exporting countries, and that will affect their profits, or it's been absorbed by the importing companies in the US. So importers have reduced their profit margins. So we showed you this chart earlier, which shows that motor vehicle prices and consumption has actually dropped. So US motor vehicle companies, where we know they've suffered from tariffs, they've not been able to pass those prices on, those tariffs on. So how has that affected their profitability is the question. And this is the price of new cars in the US, unchanged. So frankly, the White House has been right about this. They've said that tariffs would not affect US prices. But they're raising a lot of money from these tariffs. So who is absorbing the tax rises, which are, as we've said, 350 billion a year at an annualized rate? Big numbers. Caterpillar, they make, diggers, etc., have warned of a 1.5 billion tariff hit. And reminder, tariffs are a domestic tax paid by the importer. So they have not been able to pass on their the tariffs to their customers, and they've reduced their profitability. But, and this is a pattern we're going to see throughout this little section, although they have stated their profit's going to be 1.5 billion lower, their their share price is close to an all-time high. So top line share price, the bars are earnings per share. You see gentle decline, and essentially rising PE ratio has compensated for declining earnings. So the market is ignoring the effect of tariffs. In fact, the market is ignoring gently declining earnings. It's amazing. Let's move on to car manufacturers. So Ford has stated it intends to increase vehicle prices by just 1% this year, and says that tariffs will cost it 800 million in Q2 and 2 billion for the year. Share price not declining, earnings going nowhere, P/E ratio close to an all-time high. Well, close to its highs of the range. General Motors profits has dropped 35%, although it stated that mitigation measures would allow profit margins to recover slightly in H2. So it's saying tariffs will cost it 5 billion in 2025. In 2024, the net income attributable to shareholders was just 6 billion. So that is a big chunk of earnings. But share price doing all right. Again, market totally ignoring earnings which are going nowhere. Toyota, Japanese car manufacturer, tariffs will cost it 9.5 billion in 2025. So Trump is right. Toyota are absorbing a lot of the tariff, and it's lowered its 2025 operating profit by 4.1 billion to 21.7 billion. So it's done some cost cutting, but it will absorb most of the tariffs. Its share price going nowhere, but not falling. Honda, tariffs cost it 3 billion, share price rising. So Goldman Sachs estimates that tariffs will boost US inflation by a total of 1.7% over the coming 2 years, which is not really very much. And what we've seen is that US manufacturers are not passing on most of the tariffs. They're absorbing it. They're reducing their profit margins, but bizarrely, I find this incredibly odd, that falling earnings is not producing a falling share price. Instead, share prices are rising as the PE ratio expands. So I think that implies investors must expect either higher future growth, tariffs to be temporary, or manufacturers to be able to move production to the US at a similar cost to what they're paying currently for imported components, thereby retaining their previous profitability or growing their profitability given their share price is rising. Or that manufacturers will be able to pass on their higher costs in due course. Richard, what do you think?
Yeah, I agree. Sort of some or all of the above, isn't it? It is clearly, for whatever reason, the market is thinking that that the impact on earnings is temporary.
Yeah.
And what if tariffs come off in 18 months' time? Of course, it's temporary. But assuming they don't, then I mean, you can't have low inflation and manufacturers taking the bottom bullet point, manufacturers passing on higher costs in due course. So you can't. The 1.7% estimate is not compatible with the fourth bullet point there.
Precisely. Yeah.
So something, assuming tariffs remain, which is a big if, something is out of whack in the way everybody is responding to this.
Yeah, I completely agree. And on your point, on point two about tariffs being temporary, I mean, your point earlier about how when you raise taxes, they tend to stay there for a very long time. I think that's going to happen.
Yeah. I don't see that there's going to be any incentive for a future administration to come in and whatever tariffs remain at the end of Trump's term to remove them.
Yeah, I agree. I think they're raising 350 billion a year.
Yeah. So something is out of whack, and it will come out in due course.
And continue it. The last section this week.
Yeah.
We've got a lot planned. In particular, I want to talk about Brewdog, but we're going to do another podcast next week and do a lot of special sections which I've lined up. And this continues our discussion of tariffs and about tomatoes in the US and agricultural products. So Trump has moved to protect Florida's tomato industry by imposing a 17% tariff on Mexican imports. Now, 60% of US tomatoes currently come from Mexico, and there is no current alternative for winter supplies of tomatoes except from Mexico. In addition, the Trump administration is cracking down on illegal immigration and deporting existing illegal workers. It is grabbing people from the fields and deporting them. So what that means is you grab the man or woman in the fields and you don't grab the rest of their family who are left behind. And so actually a lot of illegal migrants in the US are simply hiding, particularly in California. If they know that they go out and work, they'll be grabbed off the street and perhaps their wife and children or husband and children will be left alone to try and cope. So this is a chart of arrests of immigrants in the US, and you'll see that under Trump, there's been a surge in seizures and deportations of both immigrants with no criminal record and those with criminal records. He's particularly been targeting California for ICE raids because California is a democratic state. And you'll see this is arrests under Biden and arrests under Trump. They are deporting children, but they're deporting people of all ages, people who've been here for a very long time in some cases. And that means a lot of people are just staying at home hiding from the ICE. Now, in the case of California, a lot of the low-paid work is done by migrants, and many of them are immigrants. So look at agricultural workers. About a third of agricultural workers are illegal immigrants. And so there's a report in the FT talking about how the harvest is not being brought in and the fields are not being sown with new crops. Workers are in hiding. And so that will have delayed impact on food prices. You have to wait for the crop cycle before you see the increase in prices. And more than that, if you were to get rid of all the undocumented workers in California, then economists estimate that GDP would fall by 9%, which is an absolutely enormous number. So the bottom line is the crackdown on immigration will particularly affect California, Texas, Florida. Florida's got a lot of agricultural produce as well. In addition to tomatoes, we're talking about citrus fruits, etc. And New York. So far, inflation is not showing up in inflation, but it's not just tariffs. The crackdown on immigration will lead to higher food prices in the coming year and potentially a recession in California. So all of Trump's tariffs, we're not seeing anything in the economic data, but how much of that is just due to lag effects? We'll just have to wait and see. Richard, your thoughts?
Yeah, I completely agree, Keith. I think everybody expected that within a few weeks of the tariffs, the consequences would come through, and in this case, legal. But it's going to take several years, I think, isn't it, for the full effects of them to be determined. And I mean, the other point here is this is a classic point, isn't it? So we are moving into a bit of an automation revolution, I suspect, and so there then becomes an incentive to automate low-paid workers' roles if you can't get the low-paid workers. So
Yeah.
that may be a knock-on effect of this, the removal of the illegal immigrants as well. Very difficult to tell.
Yeah.
Automation in agriculture is moving on. Agriculture is moving on a pace. So I just think the whole thing is he's thrown up all the pieces in the air, and how they all land and when they
Yeah.
land is to be determined. But in the process, there's going to be inevitably there will be a lot of disruption. Some of it unpredictable, no doubt.
Yeah, but so far, frankly, it's going his way. There's very little upturn in inflation,
Yeah.
but the lags in the system. Let's wait and see. I mean, the ICE rates in particular on agriculture, you know, not going to help his popularity if the price of tomatoes goes up by 10%, 15%.
I mean, it's going to be a significant effect on food inflation, isn't it? And
Yeah.
that's problematic, undoubtedly. I mean, the other thing is he's trying to get it all out of the way quickly, isn't he? So that by the time the next presidential, or even by the time the midterms come around, the pain is out of the way.
Yeah.
I don't know that it will be out of the way. I think it might be appearing.
Yes, I completely agree with that. So I'm afraid Richard has to leave us now as he's still recovering from his knee operation. But we will do another one on Monday where I really want to talk about Brewdog.
Okay.
Okay.
Thanks, Keith.
Thanks, Richard. And on to Inflation Watch. So we've had inflation numbers for everyone over the past month. So UK inflation 3.6%, heading in the wrong direction. Core at 3.7, RPI at 4.4. Despite that, the Bank of England cut interest rates. US inflation also rising, but only to 2.7% in June, 2.9% for core. They kept interest rates flat at higher than in the UK, despite the fact UK inflation is substantially higher than in the US. In the EU, inflation was on target at 2.0% in July. That's the flash number. 2.3% for core, interest rate at 2.15. So, i.e., monetary policy is pretty neutral now in the EU. In Japan, inflation is actually coming back down. So both core and CPI were at 3.3% in June, which was down from May. But again, interest rates 0.5%. Monetary policy in Japan is not restrictive. It's not bringing inflation back under control. China, there's very little inflation. CPI, core, headline inflation 0%, core 0.8%, interest rate at 3.1%. So this is Japanese inflation. Actually, it is fading again. Core, having shot up again, dipped down in June. So the Bank of Japan is actually expected to start raising rates again at its next meeting, having paused rate rises while it assessed the impact of Trump's tariffs. Now, we've talked previously about illegal immigration into the US, which has, pretty much come to a halt. So the question is, will that have an effect on US wage inflation? Well, the answer so far appears to be not really. There's no evidence. When you look at construction costs, there are a lot of illegal workers work on building sites in the US, then, there's been no pickup in wage inflation, construction wage inflation in the US. But is that because documented workers in the US appear to be rushing to get work permits before Trump changes the rules. Are we then seeing a surge in documented migrants going into the labour force? In which case, wage inflationary pressures may just be delayed. Summary, slow disinflation continues in most countries, he says, hopefully. The UK is actually suffering from rising inflation against trend at the moment, although expectations are that it will fall towards trend over the coming 18 months. We've said that before. Will tariffs cause a resurgence in US inflation in the coming months? Question mark. It all depends on whether manufacturers start passing through prices. Not sure. Onto other charts. So the share price of utilities in the US has performed incredibly well over the course of the last year. And that's because of demand, expected demand from data centers. And you'll see here that the new generation of AI chips does a lot more computations and they require a lot more electricity. So that whole bull market is based on extrapolating a continued rise in the computational intensity and energy consumption of AI chips. But we previously talked about how increasing the computational density of these AI large language models does not appear to be producing much better results. When will we reach the stage where just adding raw computational power doesn't really help very much? We could be there already, in which case extrapolating these charts could prove to be wrong. If we do continue to build data centers at the forecast rate, then we're going to be adding a lot of CO2 emissions. Data centers will start producing more CO2 than the aviation industry. Something to think about when you use ChatGPT. Now, after all that, you need some good news. And I like this. So this is the LibEarth House Model B, which has been made in Japan and has been constructed using 3D printing. But better than that, it's been constructed using 3D printing of soil to create sustainable earthen walls. Now, the previous model, which they called Model A, used some cement, but they're saying that just using earth, they've managed to increase the strength of the walls fivefold while reducing CO2 emissions. The inventions involved are patent pending. So 3D printing of homes would get rid of all the brickies, etc., etc., and be much cheaper, presumably, and produce a lot less CO2. This is how they build the walls. Coming to a building site near you, perhaps. Okay, concluding comments. Well, as we've gone through, it's been a month since we last reported, and a lot has happened in that month. Trump remains a wild card who seems to change tariff policy on a whim and is steadily undermining the independence of American institutions. He's going to appoint Stephen Mirren to the board of the Fed, and he looks likely to replace Jerome Powell with someone who is intent on cutting interest rates in line with Trump's preferences. He's also fired the head of the Bureau of Labor Statistics and has yet to appoint a replacement. And he did so saying that the numbers had been politicized, and he is likely now to appoint someone who gives him the data he likes. None of that is good for confidence in the US and its numbers. So you would think that is bad for long-term bond prices, in that you will no longer be able to trust the quality of the inflation numbers, or that the Federal Reserve will act against the president's will to increase interest rates when they're needed. The reason we have independent central banks in the first place is that when setting interest rates was politicized, governments tended to keep interest rates low to please consumers and business. Nobody likes having higher interest rates. As we're taking you through this, you have seen that tariffs have actually had remarkably little effect on prices, and they're generating significant revenues for government, which means that the fiscal impulse is neutral to negative. We don't know how much tariffs are inflationary. They haven't been inflationary much so far, but how long will, for example, car manufacturers be able to resist raising prices? We know that car manufacturers have taken a hit to earnings, but so far the equity market has been complacent, I think you'd say, in that their share prices have risen despite falling earnings. How long again can that continue? And Trump is also cracking down on illegal immigrants, which will have an effect on agriculture and also the economies of California in particular, but also Florida and Texas to a lesser extent. The backdrop is that the US economy is doing okay, but the labor market is definitely slowly slowing. Equity markets continue to ignore all this and grind steadily higher. Okay, couple of things to talk about in my portfolio. So this is VH Global Energy Infrastructure Fund, and it is at a big discount to NAV. So it yields 8.6%. The dividend is not covered because they have invested in lots of energy assets which are slowly coming into operation. And as they come into operation, the dividend is expected to be covered. But the directors have now voted for an asset realization program whereby the fund manager will be rewarded for selling the assets close to or in excess of NAV, in which case you would hope that the NAV discount will narrow. Now, if they would sell them at NAV, you're talking about a potential upside of 50%. Plus, you're getting a dividend yield of 8.6%. So I bought some of that. And this is alternative income REIT. And I want to talk about this for a different reason. You'll see that there was a sudden drop in the share price in late July. Now, it appears that has been caused by an RNS saying that their 41 million low interest loan at 3.19% matures in October and will need to be refinanced. Now, they had an NAV of 67.3 million, so the loan is a very large compared to the assets of the company, and income was 8.1 million. If you say that they're going to have to refinance at an extra 2%, then that implies an extra 800 grand a year in interest costs, which means possible 10% in income and therefore distributions. So two things about that. First of all, monetary policy operates with long and variable lags, and so you are still getting the effects of monetary tightening 3 years after it began. Also, when we think about how quickly the market discounts information, well, this has been known for a very long time. But it ignored the news and then very quickly, over the course of a few days, discounted it. And when I saw this, I was thinking about index-linked gilts. Now we know that the market has not at all discounted the move from RPI to CPIH, which implies index-linked gilt prices will need to fall by around 20%, 20-25%. But so far, the market is making no attempt to discount the move to CPIH. If what we've seen in AIRE is replicated in the gilts market, then actually gilt prices, index-linked gilt prices could tick along, totally ignoring the move to CPIH until, let's say, late 2029, and then in the space of a few days, drop 25% in anticipation of the move to CPIH in February 2030. Watch this space. But the market does not discount things slowly over time. It does so very quickly, ignores the bad news, and then comes to a realization and moves very quickly. Okay, thank you all for watching. It's good to be back. We will do another one next week to catch up on all the special sections that I prepared that we don't really have time to do this week. Thank you all for watching. Please can you press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.